Hey, everybody. So today I'm very pleased to have Mark Khuri with us on the show. Mark is a multifamily investor, fund manager, and a very experienced fellow in the real estate business. Mark, welcome to the show.
Hey, Jonathan, thanks for having me.
So I would love to start out if you would just give sort of a 30-second snapshot of where you are right now in your business, and then we can dig into the backstory later.
Yeah, so what we do today, Jonathan, is we provide passive investors with investment opportunities. Those opportunities are really predominantly built on relationships that we've experienced, built over the last 14 years in this space. And we invest in different asset classes: multifamily, self-storage, mobile home parks, industrial, a few other niche asset classes, Jonathan. And so really focusing on diversification. We like to reduce risk by spreading capital across different people, operators, sponsors, different regions, different asset classes, different investment strategies, very much income and growth focused in that order. But again, just really focusing on diversification.
So are you guys operating assets, or are you helping to find good opportunities for your investors, or a combination of both?
We used to, it's evolved, Jonathan. Today, we don't operate any of our own assets. That's on purpose. We partner with other operators that do that in conjunction with the business plan of that and specific investment. But we started out as operating partners. We were very heavy in single family and small multifamily for about 6, 7 years before transitioning over to more of the private equity capital raising, partnering with other operators.
And what was the reason for the shift?
Yeah, I mean, a couple of things, Jonathan. In the asset classes that we were focusing on as an operator, margins kept getting squeezed. That was a big one. And we started seeing that the returns just weren't quite as attractive for the risk that we were taking. And then historically, single family specifically has been correlated to the overall economy, right? You've seen valuations typically go down during a recession. And we wanted to be a little more insulated because we thought that we were maybe in the ninth inning of the cycle and there could be a correction soon. So all those various reasons basically put together, Jonathan, is why we decided to pivot.
But also from direct operation to a funds allocator model. Why did you stop operating your own deals and start focusing more on partnering with other operators?
Yeah, I mean, it wasn't like a line in the sand. We just flipped a switch one day. We were doing both in conjunction for a number of years. And we just had enough data to kind of see risk versus reward. And we found that the better path for us as investors is to, in our opinion, to go down the equity model and be more diversified and to be more spread out from a capital allocation standpoint.
And so, like, when you say that you're diversified, you're talking about being diversified on an overall basis because you've got lots of money and you've got deals. Sorry, you've got money in lots of different deals, or do you have funds that you raise that are investing in different kinds of deals? Like, what is the diversification model exactly?
Yeah, it's both, Jonathan, right? So we offer, single asset investment opportunities where an investor can invest at 123 Main Street. And that one property will have a specific business plan, a term, a duration, projected returns. We also combine multiple opportunities into a fund. And so an investor can invest in the fund, and then their capital is subsequently spread across all the deals in the fund. And that's really how we diversify. We can get into more if you want on how we think about that, what we do, our strategy, et cetera. But from a general standpoint, that's really how we focus.
Yeah, I mean, I would love to talk about both, actually. I mean, I'd like to talk about so let's start with the kinds of assets that you target. Maybe talk a bit about your decision-making process around what kinds of things you invest in. And then once we're done with that, let's circle back and sort of talk more about the structure of the fund itself and how you set that up. So
Sure.
what kind of assets do you like? Why do you like them? What's your decision-making process behind it? Just delve into that a bit.
Yeah, I mean, this all stems from experience too, Jonathan, right? So myself and my family, we've personally invested in many different deals over the years, over 12 different asset classes just within real estate, from short-term debt to senior living to student housing to oil fields in Texas. So we've tried a lot of different stuff over the last 15 years or so. And we've narrowed it down, I'd say, in the last 5 years to where we think we can get the best return for the lowest amount of risk. And so what does that mean? From an asset class standpoint, some apartments meet that criteria, some self-storage, some mobile home parks. We invest in ATMs. We invest in triple net industrial sale leasebacks as well. And then, our goals for almost any one of our investments, Jonathan, is to be able to provide our investors with a 3 to 7% cash on cash return in year one. And we want that to grow with the average cash flow while we're holding an asset to be between 7 and 12%. And then once we add in the profits from the sale, the lifetime of the investment, we're typically shooting for around a 15% plus average annual ROI, not to our investors.
And how are you selecting these assets to invest in?
Yeah, it's a patient, disciplined approach, really, Jonathan. So we look at about 10 to 20 deals a month from different sponsors and operators across the country in different asset classes that we've vetted and underwritten. We invest in 5 to 10 a year. So it's roughly, 97% of what we see doesn't work for what we're trying to do. Doesn't meet our goals or criteria, or it just may not be anything special, right? There's a lot of deals out there that are okay, but what makes it special? Why is it better than anything else? And so we're just trying to find something that has a story that we think makes it unique and that can help us reduce risk and also have a great return. And so that's more of the holistic approach. As far as specifics, if you want to get into, underwriting and analysis and how we do it, there's a lot of different variables that come into play as to what we look at. A common one for us is, operating expense ratios, if you want to get technical, right? So mobile homes and self-storage and tax exempt apartments, to be specific, tend to have very low operating expenses compared to other real estate asset classes. Thinking, 30%, 35% is quite common. Whereas your traditional multifamily might be more like 50, 55, 60%. And then if you think about a single family, you're at like 70, 80%. And so that is a quick way to just check on free cash flow and the ability of the property to endure, different changes in the marketplace, occupancy adjustments, changes in potential demand at the asset, et cetera, and still be able to produce positive cash flow. We look at a lot of other variables too, Jonathan, the vacancy rate, bad debt, what's the interest rate, of course, and the going in cap rate. Today, we're very much have been focused really since early 2022 on finding opportunities where the going in cap rate is, there's a nice pad between that and the interest rate, the borrowing rate. We're looking for 100, 200 basis points of spread if we can find it. And it's hard to find, but when you do, you're just kind of setting yourself up at the beginning of investment to see more success than, negative cash flow, of course.
I mean, drilling down on, say, apartments, for example, because that's obviously like one of my areas of expertise. What is it that you're looking for in an apartment deal, or what makes it? You mentioned you're looking for deals that are special, that have some kind of story to them. Give me an example of what that would look like.
Yeah, I mean, just in 2023, we invested in a handful of different apartment deals, Jonathan. The consistent theme for us has been tax exempt apartments. These are apartments that don't need to pay property taxes. And that is a huge benefit. There's a really compelling strategy there that we've continued to focus on since 2021. And, why that? What difference does it make, right? Well, really what these deals are, we're usually acquiring an existing asset or assets from a seller. They're typically 90% plus occupied when we buy them. You tend to see newer vintage, not always, but usually 1995 to 2022 build. We've invested in the last year and a half. In growth markets, most often Texas, we're looking at these assets from a cash flow standpoint and a growth value add standpoint as well. So the 1995 deal we just recently did, Jonathan, two properties next door to each other, over 500 units, 94% occupied. They're the only two within 3 miles that have not been renovated. The rents are below market. And we're putting the tax exemption structure in place on the assets while in escrow. So once you buy them, you don't have to pay property taxes for 99 years. And you're able to get this pretty large gap in delta between the purchase price and the appraised value, pretty significant. So from day one, you're creating inherent value, and that's something we like to see.
Can you talk about this tax exempt strategy? So how is it that you're able to get properties into whatever program it is that exempts them from paying property tax?
Yeah. What it is our operating partners will enter into a public-private partnership with a local municipality, and we allocate half of the units at the property for an affordable component that's tied to the AMI, or the area median income. And you're keeping the rents and the income for those units restricted. The other 50% of the units can go to market. You can raise rents as much as you please. So in exchange for doing that, you're given a tax abatement from the property taxes. So you're essentially creating affordable housing. So that's one benefit. And you also are able to get very attractive agency-like financing, where we have 10-year fixed rate interest only debt at 75% loan to cost. And so you have a nice structure there as well, where the interest rate and the borrowing costs are also quite favorable.
Are you able to raise the rents on the subsidized or fixed, the low income units at all, or is it is it some kind of like matrix that you're allowed to use that allows you to raise rents to some extent? How does that work exactly?
Yeah, so just to clarify, it's not subsidized housing. Everybody has to qualify. They still have to
Mm.
fill out an application. They have to have income. It just depends on how much, right? And so you're actually providing affordable housing, but to more of the what we call working class folks, right? Um, People work at hospitals, schools, teachers, you name it, all of the above. And with that, the area median income for a specific area of the country is published every year.
Mm.
And the amount of rent that you can charge is based on that. So we also look for markets where there's been usually 10 years or more of area median income growth consistently. And so that you can raise those rents. Again, still providing affordable housing, but it's just based on the local area median income.
So is it like some fraction of a quarter, a third, or whatever of the median income is the top rent you can charge for these units? Is that how it more or less
Yeah,
works?
it can vary depending on location and the partnership deal terms with the local municipality. A lot of times you'll see 80% of AMI. So it depends. There's a formula there, and it's all put in writing, and you got to follow the rules, of course.
And is this a program that's just available in Texas? I mean, I've heard of operators doing similar things in other states. I think, South Carolina, I'm in a deal there where they're doing something similar, but I haven't heard it as being, these are usually deals with some kind of local charity as opposed to like a public-private partnership with the municipality itself. So I was just wondering if this is a Texas-specific program, or have you seen this elsewhere?
It's not Texas specific, Jonathan, but it works well there. You have a very high millage rate for taxes in Texas, one of the highest in the country. And you also have relatively affordable housing. And so those two things together work well, but it doesn't work everywhere. Like, I'll give you an example. In Austin, Texas, we were looking at a potential structure on an apartment community there. The rents were already way too high, Jonathan, 1,800 to 2,400 a month. And in order to get it to be affordable, you'd have to lower the rent significantly. And the savings in taxes just didn't, it's a cost benefit analysis. There wasn't enough there for it to pencil. So there's a little bit of a sweet spot where it has to make sense for everybody, or why bother doing it, right? Just buy the asset and operate it, and don't bother with the additional administrative tasks and, of course, management tasks of keeping 50% of the units affordable. So You can do it other places. It's just difficult to do and it has to make sense in pencil.
And I guess, I mean, there's a compliance aspect to this as well, right? That you don't have with a completely, you know, free market property. So you have to have people who are expert in this, you know, on the property to administer it properly.
Absolutely. Yeah. This is not something you want to just go try and do without having an asset management team in place that understands all the rules, the guidelines, the processes, the reporting requirements. I mean, typically there's a team of attorneys on both sides of the table putting this kind of deal together too. So it's not for, I would say, someone just starting out who wants to go do this. You know, make sure you're very well educated on how it works and working with folks that have done it before.
And so flipping things around to the other side, with the investor side, um, who are your typical investors, and why do they want to, you know, work with you as opposed to just going straight to the sponsor and presumably skipping out on a layer of fees? I mean, you have to make money too. So,
Sure.
yeah. So who do you target as investors, and what's the value proposition for them?
Yeah, a couple of things, Jonathan, that come to mind, right? We predominantly work with high net worth individuals, a lot of entrepreneurs, some CPAs, attorneys, a couple wealth managers as well, who are looking for assets and investments they can invest in passively, number one, and with trusted partners. That's the biggest part. And so, you know, we've been in the business for 14 years formally and started investing prior to that. We met a lot of folks, a lot of sponsors, a lot of operators, over 140 we've vetted, underwritten, analyzed. And today we work with about a dozen. So about 90% or more just aren't a good fit for us. And that is a 10-year process, Jonathan, to come up with that list I just shared with you. It doesn't happen overnight. It takes a lot of time to find the right groups and operators to work with. And then from there, you know, we have another level of course, underwriting and analysis. Even when an operating partner that we do like and have experience and active capital with sends us a deal, doesn't always make sense to us. We're not always going to invest in it. And that can sometimes take up to a couple months. Even just trying to understand the tax exempt process that I just explained to you, that was about 6 months of analysis for us and doing due diligence in conjunction with our operating partners, lots of Q&A, lots of spreadsheets, a lot of legal paperwork to understand that whole entire program before we felt comfortable doing anything. And then first, we made a personal investment before offering anything to our investors. So our investors know that by the time we send anything to them as an opportunity, you know, it's got our stamp of approval on it. Let's call that. I'll call it that. And today, you know, we're at the beginning of January. We haven't had a new investment in 5 months, Jonathan. You know, there just hasn't been anything that makes a lot of sense for us. And so I think our investors respect our patience and the fact that we're doing a lot of due diligence. And at the end of the day, we're also almost always negotiating more favorable terms with our operating partners from our group. So that helps, of course, offset, you know, SMK's management fee and split.
Mm.
So the net return has to make sense for our investors, or we just won't do it.
And then, so let's talk a little bit about the fund structure. So tell me, so what, first of all, I guess just basics. So what kind of fund or funds are you operating?
We'll typically create a closed-end fund, Jonathan.
Mm.
We'll combine multiple assets, operating partners, asset classes into one investment offering. So with one investment, an investor can spread their capital across multiple deals and regions. Again, focusing on income and growth. So we're usually trying to hit that 3 to 7% cash on cash and to our investors in year one and going up from there. And so that's a quick overview, but happy to dive more if you have specifics.
Yeah, I mean, I'm curious about how this works. You know, do you, so if you say, let's just take an example. So you say you have 5 different assets in this fund. Do you have 5 assets lined up that, you know, well, I guess, do you have the money first and then you go look for the assets to invest? Do you have the assets lined up first? Are they coming into the fund all at once? Or are they coming in piecemeal? You know,
Yeah.
there's a lot of, you know, what I've noticed is there's a lot of people out there who are sort of touting the fact that they're running funds, but what they seem to be running is like a bunch of deals together that are sort of nominally under the same management, except you've got some investors in some and some investors in not in them, and it just seems like a bunch of syndications all sort of stuck together, as opposed to what I think of as a fund, which is your investors give you money and then you allocate it with discretion into certain assets. So it, it sounds like you're
Yeah,
doing the
interesting.
latter. Is that, I mean,
Yeah, it's the latter, Jonathan. So um, I'll give you an example.
yeah.
We're soon to close our Alternative Income Fund 3.
Mm,
We opened this up in early 2023. We opened it then, Jonathan, because we saw three deals that we wanted to put together around the same time. So we said, okay, each one of these has pros and cons, just like every deal. But when you combine them together, you actually end up with a better risk reward profile.
mm.
So that's why we started creating the fund. So we had those three deals. So we raised a little bit of capital from our investors to start. We funded those three deals over, let's say, 60 days. And the fund remained open. We continued to raise capital and we accept it into the fund, and we continued to invest into other deals. So we ended up investing in this fund so far 7 different deals across mobile homes, self-storage, apartments. We have a couple fixed income investments as an allocation in the fund as well, and in private real estate debt. Those tend to pay higher current income, but don't have much growth, of course. And then we have a small portion allocated to what I would say more value add deals as well, where most of the allocation of the portfolio is into income and growth investments in real estate. So it's very strategic. You know, we have about 28% of the fund allocated to fixed income and the remaining 70% plus into income and growth real estate assets.
And so every investor in the fund is, I mean, their investment is in the fund as opposed to individual assets within the fund, right? So even whoever, if they come in the beginning, they come in later, they're still getting the diversification of all the assets that are in the fund.
Exactly.
Yeah. So this is what I think of as sort of like a true traditional fund, as opposed to a lot of what I'm seeing out there. I think people are kind of, making them seem more important than they actually are by calling themselves fund managers. But what they actually have is like, hundreds of investors all in different deals within this thing that they've called the fund, but I don't really understand what that is. So
I don't either after what you just described. So
yeah, that's what it seems to be as far as I can understand.
okay, gotcha.
So yeah, okay, cool. So and so how many of the funds have you done so far? This was your first one that you did, or you said this is number 3 that you've done, fund number 3.
This is the third, what we call alternative income fund, Jonathan, where you're going to be investing in spreading capital across some of the asset classes I mentioned. But I mean, we started creating funds similar to this when we started, in 2010. I'll give you a quick story. My father and I opened up our business, and when you start, you have to talk to people that already know, like, and trust you, of course. So we invited our friends and family and some colleagues over to our home in upstate New York, and gave them a good old-fashioned PowerPoint presentation in our basement, right? And started raising capital that way. That was for a blind pool fund in 2010, which was, I kind of chuckle about what we were doing looking at it now, because
that was hard to do. That was hard to do.
Very hard, very brave, very much, I would say, naive to the reality of what was going on in the world. But we had been investing as a family in different assets in different regions for the past 5 years. And we really just were expanding on it at the time. But the idea of the fund for us was predominantly my father's preference, because you reduce risk. You can spread your capital across multiple assets, all with one investment. And so that's how we got started. We've created multiple funds since then. We still do usually about one fund a year if we think there's enough deal flow. We'll see what happens in 2024. It's been very slim from a good deal standpoint for us for the last several months. But we also do single asset investments too, Jonathan. It really just depends on where we think the best position for capital is, right? And how we can hopefully do better than the overall market.
And what's the typical size of these funds that you're raising?
Relatively small, 2 to 5 million in investor capital. We'll invest those across. Again, Alt Fund 3 is 7 different investments. So We've been investing for about 8 months through that fund and that vehicle, and that's where we are today.
And then sort of fee structure, asset management fee plus upside on the back, like 2 and 20 structure or something similar to that, or?
Yeah, we do. We have a couple different class shares within the fund, Jonathan, depending on investment amount, ranging from 50K up to 500K minimum. And then what we'll do is we'll take a 10 to 20% split of the cash flow that comes into the fund.
Mm.
So it's a really simple structure. We avoided the preferred return structure on purpose. We're doing this for income and growth. And so our company, SMK, earns a 1% annual asset management fee. That's on equity invested.
Mm.
And then 10 to 20% of the net income, we basically split it with our investors. They get the remaining.
And how I love the fact that you raised a fund in 2010, sort of because you didn't know what you were doing, which is probably the only way to have done it back in that day, so not that much longer thereafter, after doing several deals myself, I thought, okay, the next step is to do a fund. And what I ran into was just a lot of people saying, I don't trust anybody with a fund. Just show me deals. Right. And so you
Yeah.
could argue, I could argue till I'm blue in the face that, look, you're getting a lot more diversification if you invest in a fund, but they were like, well, we'll diversify ourselves. We'll just invest in multiple deals.
Sure.
Probably the difference between what you did and what I would try to do was that I was approaching family offices. They really had the ability to allocate a lot of capital across a lot of deals, whereas maybe somebody who only has $50,000 to invest or $100,000 to invest doesn't. That's just their one shot for the year, right, to invest, and they don't have the opportunity, and they really can't say 5,000 here, 10,000 there. They wouldn't even qualify for the minimum. So it actually works quite well for someone like that to be able to invest in 7 different assets, with their 50 or 100K. So
Yeah. The minimum, the idea of the minimums behind each underlying investment is definitely a topic for sure. I mean, we calculated on a previous fund, I think an investor would have had to have 1.2 million just to be able to invest in all the deals that we put in that one fund, where our minimum was 50K, so they could spread it across. So there's obviously a large advantage there. And we have investors that think the same way, Jonathan, like a fund's not for me, but they'll invest in the individual deals. And then we have folks that do both. They like the fund. Okay, this one's lower risk, and you're diversifying across everything that you've seen that you think is a positive, smart investment in the last year. I'll throw my money in the hat on that as well. And we have some folks that just do funds because they're not interested in a single asset risk,
right.
especially in Texas near the Gulf. I mean, the weather risk alone will deter people from investing there. And so, that's not, you're not going to be able to satisfy everybody and their wants and needs from an investment structure with just one strategy. And I'm personally an investor. My family is as well. Jonathan, we've been investing in our own deals since day one, and we create them because we think they're very attractive investments, from an investor viewpoint.
Have you sold any of your funds yet, or are they all still operating? Like, have you
Yeah, I
closed
mean,
any funds? Yeah.
So as far as exits,
I'm sorry, exit is the word I was.
That's okay. Yeah.
Yeah.
All of our single family and small multifamily portfolio has been sold. That was over 60 properties that we bought, renovated as an operating partner. We sold the last one maybe in 2022, Jonathan. As far as more commercial real estate syndications that we've personally invested in and our companies created with our investors, we've had 16 exits to date, those assets as well.
I mean, I was actually really asking more about exits from the fund because the reason I was asking was because I was curious about the process of winding down a fund. And so
Yes.
have you been through that process yet, or?
We have, yeah. We've
Yeah.
had exits inside of a fund. We've had some funds fully closed where everything's exited. We have some funds that have had, 2/3 of their capital returned to them through some of the underlying property sales and refinances. So we're still holding the remaining. The fund isn't completely closed, but investors have gotten a lot of their capital back. And so it's a bit of a spread, just depending on, when the fund was opened, how long it's been in existence, and how it's been doing.
Yeah, like typically, how long are these funds open
Most of
for?
them are 5 to 10 year holds, Jonathan.
Yeah.
Um, we kind of stay away from shorter term deals. We stopped
Mm.
doing shorter term deals in late 2021, early 2022, once we saw kind of the market changing with interest rates going up and the Fed battling inflation.
Well, I'm curious, you have, so your fund is set up to be, say, a 5 or 10 year fund, and the deals underlying, that you're investing in, like, I mean, you're not controlling the timing of sale, right?
Right.
So have you ever had, like, what happens in the case where, like, maybe it hasn't happened yet, but I'm just curious, like, what would happen? Like, if you wanted to wind down the fund and you had one asset that was not being sold for whatever reason, like, just sort of, what do you do in that situation?
I mean, you can't, right? You're not going to
Yeah.
wind down the fund without selling all the assets unless you bring in some kind of rescue capital that pays people off, or, I'm not even sure, Jonathan, what we do. So
Yeah.
we just follow the deals in the fund.
You just keep on running it until
Just
finally
keep
it
running it,
sells, and
keep
then,
running
yeah.
it. That's it.
Yeah.
Yeah. We haven't had a situation where we have had to try and shut something down early.
Mhm.
And we always tell our folks, the projected duration of the investment up front, but of course it's a projection. You never know what could happen. Now,
Right.
we've had investments that sell much sooner than we thought they would. So on the other hand, that's a positive thing as long as they're
Mhm.
doing well. And but yeah, at the end of the day, it's you have an illiquid asset, right? And so you have to wait for that liquidity to come through a refinance or a sale.
What kind of marketing do you do for your, just in general, to bring in investors? What does that look like?
Um, what do we do? So, we've got a quarterly investment report that goes out to a lot of folks in our network that talks, it's a two-pager, Jonathan.
Mm.
Market updates, different assets that we're investing in, what we're seeing in the past 90 days and the next 90 days. And so, kind of a quick snapshot spotlight. A lot of folks digest that and get a lot of information from it. As far as, kind of colder outreach, I've probably been on over 40 podcasts over the last 4 or 5 years,
Mm.
talking to folks like yourselves, just sharing what we're doing, learning from others. Attend a few different real estate investment expos, workshops, some virtual, some in person each year. Other than that, it's not much else. A lot of it's organic growth from existing
Mm.
investors that refer others to us.
And so where you want to take this in the next, I'm looking at the clock and seeing we're kind of running up on our time budget here, but I'm
Sure.
curious sort of where you want to take this, in the next 5 or 10 years. What's your ambition for SMK?
Yeah, I think the ambition, it's a good question, John. At the beginning of the year, you start thinking about these things, right? And so um, I would like to work with more RIAs, wealth managers, financial advisors. That umbrella has been, we've only scratched the surface there.
Mm.
And the folks that we find are a good fit tend to be looking for alternatives for their investors and are also able to understand and do the due diligence on deals to see if they're a good fit. And so I think more of that down the road is definitely where we're focusing.
I find that interesting too, just the way that that's developed, because I remember when I first got into the business, if you ever went to talk to a wealth manager about what you were doing with, private offerings like this, they didn't even want to talk to you because it's like, well, I'm not going to get a fee on this. So I don't want, they were thinking, oh, my guy's going to be investing 50,000 with you, not with me. And I'm not going to be getting the fee on this. So I don't even want them to know about you. It seems
Sure.
like now a lot of they've changed their tune because they see this now as offering a service to their investors to make introductions to qualified, people, because the investors are going to find these deals anyway. So they
Right.
might as well be the person who gets the goodwill from the introduction, right? So it kind of has changed a bit, I think.
Yeah, absolutely. We're hearing that all the time, Jonathan.
Yeah.
Like my investors want to invest in stuff outside of the stock market. So what do you have, right?
Yeah.
And how can we make this make sense for everybody? And so there is a way to have them still earn their fee, whether they invested in a mutual fund or in a private real estate fund. It just depends on the advisor, if they're registered, if they're not, you name it. And so there's a lot of different variables there. But you're right, there's a lot of folks that they just they won't even talk to you. So it's a little bit of a digging and patient approach to find the right partners.
Well, so if people want to, get in touch with you, maybe become an investor, or at least just learn more about what you guys are doing and the funds that you offer, what's the best way for them to get in touch?
Yeah, again, our company name is SMK Capital Management. Our website is smkcap.com. People can sign up to join our investor group there, Jonathan. There's a spot right on the homepage for that. And then they can also email me. I tend to talk to every one of our investors at least a few times before they decide if we're a good fit. And my email is info@smkcap.com.
And to get that newsletter you mentioned, how do they get that?
Yeah, if they sign up to register for our investment offerings and become join our investor group, they'll get those newsletters as well.
Awesome. Well, I highly recommend everybody to go and check out smkcap.com. And Mark, it was great meeting you, and thanks for being on the show today.
Thank you, Jonathan, for having me.